every single deal that we look at, we probably have 100 and something different little filters to make sure that we're in tolerance, and that, to the percentage of units that we don't allow us. We need to have at least 70% of our units being 2s and 3 bedrooms, right? Or we have the income, or we have the house value, or we have to have a certain amount of revenue growth in the first 3 years in order to make the deals work. So there's just a bunch of different factors.
Welcome back to the Massive Passive Cashflow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if that's the case, because you can do that too. We have a great guest today, Michael Pouliot from beautiful Colorado, Boulder, Colorado to be. In fact, if you're an outdoors person, there's no better place in Colorado, man. I got to tell you, so I'm envious. You live in a great place, Michael. So if you wouldn't mind, give a little bit of introduction about yourself, because like with me, most of us didn't start off doing this thing in the crazy world of real estate. We were started off being an engineer or an accountant or something like that. So take us to that pivotal moment. What was the inspiration for getting into real estate, if you don't mind sharing,
Yeah, absolutely. So my family's been in real estate since the post-World War II period. And so I kind of grew up around real estate, not so much what I'm doing now. There's no sort of, family business that kind of went from generation to generation, but everyone kind of had their own version of real estate. And so my father was building homes, and I would be digging holes and doing leveling ground and dealing with drainage, just a lot of like day labor type of stuff. I think what I learned from that experience was, hey, I don't want to do this at all. This is hard work. I remember getting up at 4 a.m, going down with my grandfather to the job site. He was my father and my grandfather worked together, and my grandfather, even in his 80s, was the foreman, right? So anyway, so I ended up saying, hey, this is not for me. I'm going to go into finance. So I went into finance. I worked on Wall Street and pursued a career there, and then financial consulting. And what I realized in the beginning part of that first 10 years of my career, that I was trading time for money, as I think a lot of people realize, especially in consulting. You're very much trading time for money. It's very obvious. And so I just said, hey, listen, I got to figure out how can I do something where I'll do the work and they'll be paying dividends forever, right? And that certainly wasn't the case in consulting or in the fixed income desk at JP Morgan. So I would say it was 2016. It was also around the time I got married, had my first kid, and I was like, hey, this is not sustainable. I need to have something where I'm my own person. I had some independence, and that's why I started buying single family homes. And kind of the rest is, I'm sure we'll get into it, but the rest is sort of history. It kind of just built from there.
Yeah, well, that it sounds like some kind of thing with a lot of people I meet. You start off in life doing what you believe was the right path for you based on your life journey up to that point, which really isn't much. It's basically people, hey, you should be a doctor. Hey, you could probably be a great engineer. So it sticks with us. But same with me. I got a degree in computer science, and I did use it for probably 18 years, and I don't regret it. It got me started. My gosh, it gave me the money I needed to start investing. But it was the reinvesting that was the thing. Real estate. I mean, even today, this January 2026. Will actually be 40 years. So I bought my first property right out of college with my college roommate, and I was hooked. For like to say, the rest they say is history. But I don't want to get into that because people don't want to hear me; they want to hear you. So, so take us down memory lane. What tell us about the first flip or rental? You can do one of each, and then and then we'll go forward from there. I want people to hear what you actually did, how you did it, because a lot of people don't even get out of the starting gate, Michael, because it's just fear of the unknown. Classic. But having regular guys like us say, look, this is what I did. This is nothing more, nothing less, no magic. It's just boom. You really do help people when you do that, if you don't mind sharing,
Absolutely. So like I said, it was 2016. I was living in Jersey at the time, and with my wife, and she was, we had just had our first child, and I was looking for a BRRRR. Can I find a project where I could buy it and recycle the capital, because I didn't really have a lot of money. We were only 5 years out of college. at that time. So I had a good paying job, but my wife was at home, so I was single income family. And so I took a HELOC out of my primary residence. I used that as the equity and then the rest of the money came from a hard money loan at that time. So I know the exact deal. I could say all the numbers. So I closed the first deal August 15th of 2016. It was a $25,000 purchase price, 2 bed, 1 bath, 900 square feet row home in a little neighborhood called Grays Ferry in Philly, which at the time was in the path of progress, next to another area called Point Breeze, which was blowing up in a good way. And so I bought that property for $25K. I put $30,000 into it. I then went to a local credit union, got it appraised for $125, refied that thing at 100, took out all my money and then some. And then all of a sudden I had money to do the next one. And I said, hey, boy, this is easy. So I was like, hey, let's just do it 4 times at a time. Obviously, I learned a lot of lessons as I continued to go on. But that first deal really was the template that I then applied essentially since then all the way now. Now, more numbers, more zeros, et cetera. But same idea. Buy it, at a great price or at a fair price. Do some sort of value add, either operationally or otherwise, and then get that value up, recycle, and repeat.
Well, you know what? That 2016 was a good time to do that because we were out of the recession years, and yet pricing was still favorable. We hadn't the bull market hadn't really shot out like it did after the pandemic started. Yeah. And in Philly, one of my nieces lives there, by the way, and she bought kind of right before the pandemic. And prices had already gone up. I mean, back in the 10 years before you bought that, people were, you could have buy them a lot less than that. It was crazy. Mm-hmm. But now look at what's happened to the prices there. Oh my gosh. you're sitting on a gold mine if you got properties that you bought, 10 years ago, right?
Absolutely. Yeah.
Okay.
I can give an example of that. If you like, I purchased a bunch more of those because, like I said, I was rinse and repeat. So I started moving from there to West Philly. If anyone's watched Fresh Prince of Bel-Air, West Philadelphia, born and raised, that area has come a long way. There's a lot of eds and meds in Philly, and they really expanded Drexel and the health systems over there. So Drexel University and then other health systems. And I was buying property, through 16 through 18 or so. And, I was buying either direct to owner or through wholesalers for at 30,000, 35, 40, 45. Now those same properties are going on the wholesale market for 75, 80, 90,000. And I was getting appraisals at that time in the mid 2010s at about that 125 to 130 for that 1,000 square foot unit. And now those properties are worth 2.25, 250, right? So not just doubling your equity, you're doubling your, the value, which is pretty significant.
Yeah, the cash flow, the rents alone. It really is Philly, going back 20 years, maybe more, started becoming a real hotspot for millennials. They just were attracted to it. I have to admit, I go there and we go out with my niece and stuff, and it's great. There's little parks, there's pubs everywhere, little neighborhood restaurants, and it's just classic old school American. Look at that. It's the seat of America. It's Philadelphia. It's where the Constitution was, or the Declaration of Independence was drafted. You can't get any better than that as far as history goes.
Absolutely.
So now, when did you move out to Colorado? What time frame was that?
So that would have been around 2018. At this time, I was still working at my job. So I did not leave my job to pursue real estate directly until I had a 6-figure salary. So, I needed to make quite a bit of money from real estate before I felt comfortable moving on from there. So in 2018, I was still in consulting, but my job was such that I didn't have to be in office. So I maintained that job, moved out to Colorado, continued the consulting work for about another year and a half. And about 2019-ish, that's when I was able to kind of leave the job and go full-time in real estate. I had made enough money, had enough savings, as well as enough cash flow and prospects to, feel comfortable doing that. Yeah.
Okay. Very good. Now, how many did you do on your own And then when was it that you started, doing like you probably started off doing partnerships, maybe, or did you go right into raising funds, or how was that transition?
Yeah. So in the beginning, you don't know what you don't know in the beginning. And so I didn't even really think about raising money at all. I just figured I would, what money do I have available to me? Where can I, how can I do that? That's why I went with the HELOC. That was cheap money. And then I was like, I'll just recycle. And so I did about 50 transactions. Not I wasn't carrying them all at the same time, but I was cycling through them over about a 3 year period between BRRRR strategy, and then I did a bunch of foreclosure flips in some judicial states that were still dealing with foreclosures from the financial crisis. And about that time is when I also realized, wow, this is a lot of work, and I don't seem to be making as much money as I thought I was going to make on a cash flow basis. And when I pay the bookkeeper $1,000 a month, and like that's 10 units of cash flow, I'm like, it's a year of work that on the BRRRR side. So I realized that yes, if you have no expenses, $100 a month is great, but in order to run a business, you've got to have there's some expenses. And since I wanted to make this into a business, it was about 2018, 2019. I started to joint venture with individuals, started to think about raising capital, and I started doing larger transactions. 20 to 50 unit apartment complexes is kind of what I started with, and then grew from there.
Were those in Philly, or they were in other parts of the country now?
Yeah, so by that point, I had moved to Colorado, and I was looking for, hey, where, and maybe I made the wrong decision. Hard to say now, but hindsight being 2020. I was in Colorado. I was like, hey, where can I fly and get back same day, and have because I had a young child and didn't want to be away too long. So going back East Coast is kind of a slog. And so you kind of kill a whole day and a half. And so I said, okay, well, where are the major metros I can go to? It was Dallas or Chicago. And so I looked at Dallas and I looked at Chicago, and I was like, Dallas is very competitive. The cap rates were really low, even by that point. And there was like a 200 basis point delta in cap rates from Dallas to Chicago, suburban areas. And so I said, hey, I'm a cash flow investor. I'm looking for cash flow. I don't need some crazy appreciation. Let's go into Chicago and apply the same model, buy it, renovate it, rent it out, and refinance. And so that's what I did. And over the following 24 months, acquired another 200-300 units through JVs and individual kind of blocking and tackling with investors.
Okay, all right. So that was at about that point that you started doing, doing the raises,
Yeah.
fundraisers, and okay, all right. Now here's a big question. It's the how question. So, like we all have our own systems and way of doing things. I pay for some systems to use. Some of them we built.
Mm-hmm.
But how are you going about? Like, what's your strategy for identifying the properties? Are you leveraging people in those areas? You're leveraging system, or both? Or kind of take us down that, unravel that a little bit, if you don't mind.
Yeah. So I've always been on kind of the deal side. So I always found the deals myself. And when I say find it myself, there's typically going to be an intermediary, some sort of broker, even for an off-market transaction. So what we typically do is we reverse engineer who are the 50 brokers that have relationships with the owners that we want. I'd rather have, and really when 50 becomes 10. So it's basically like in any market, in the middle market, that's where we operate now, deals between 10 and $50 million. We're really focused on, in every single MSA, there might be 5 people who control 90% of the inventory. And so we just try to maintain and develop those relationships through conversations, through providing offers on anything and everything they have, and then attending events, NMHC, other events as well. Doing podcasts either as a guest or having them on. So just trying to build a relationship, and then when we are in a transaction, just performing according to what we said we're going to do and being a good buyer. And then we typically get access to deals first, off market, or just because in the very specific niche that we operate in, which is we're looking in very specific areas for very specific types of deals. So
okay, all right. That sounds good. Now, how about I like to call them team members. They could just simply be, non-official business associates. But when you go into an area, How do you identify the people like contractors, title companies, all, everything that's related to real estate, inspectors, things like that? You're part of a network like RIA, or is this just, I mean, if you could just kind of
Sure.
run with that for people a little bit.
Yeah, so I'll start this sort of like two ways. So like when I first started versus what we do now, I think is kind of helpful. So when I first started, it was like RIAs. I would go to local events, I would meet someone, and then they would refer me to someone, and then I would maybe bid out something to three or four people, try that person out, realize I, didn't pick the right person, and then try someone else or whatever. Or I would, work with a bank, and they would refer me to an insurance guy, or vice versa. And so it was a lot of direct referrals from, I'd find someone good and see if they could refer me to someone else who was good, and sort of slowly build the Rolodex. Not that anyone uses Rolodexes anymore, but build the contact sheet, so to speak, in the market. And I was also operating in a single market, so I could focus on. I only needed 6 or 7 really great people who could help me with this stuff, right? A couple people to help with sourcing, transaction folks, and a couple contractors, and I could pretty much make do, especially on single family. Once I started to, now at this point, we're vertically integrated. We have our own property management company, which we built. And so we have our own team members, which we hire. We have very specific processes on how we hire people, how we bring them into the company, the core values, and the skill sets that we're looking for. So now it's sort of different, but there's still a referral aspect to that too, because even those great people that we bring into the company, they're usually bringing their Rolodex that they built over 10, 20, 30 years of experience in their market. So we sort of almost acquire through hiring those Rolodexes by bringing great people onto into our business.
Yeah. Okay. Now, what's the you work in different sectors of real estate? In other words, do you do some retail, some storage, office, as well as multifamily residential? I mean, you have what's the range of your target properties?
Yeah, we're very focused on vintage 70s to 90s vintage value add housing, renter by necessity, workforce housing, B, C class apartments. We
Okay.
focus, and that goes from how we have our conversations with brokers to how we underwrite deals. So, and as an example of that, we're looking for primarily families to live in our communities, which means we're mostly looking for 2 and 3 bedroom unit properties. That means we're mostly looking for 1,000 square foot average unit sizes or higher. We'd like to see properties with a lot of 2 bed, 2 bath, 3 bed, 2 bath versus 1 bath. No one wants to split. A family doesn't want to split 1 bed or bathroom. That ends up being a problem. And we're looking for places where we're 8 out of 10 or to 10 out of 10 on greatschools.com. So we're looking for families that value education. They want to be in those school districts. We tend to see stickier tenant base, longer retention, and that leads to a cleaner property, better cash flow, a better experience for us as the manager and for the investors. So that's what we're primarily focused on.
Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live, and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part: no selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you.
Okay. Now, how about exit strategy? When you buy a property, do you your market say, hey, this is an 8-year hold, this is a 12-year hold, that kind of thing? Or how do you determine your exit strategy, and what actually is the exit strategy?
Yeah, so our view is, generally speaking, once we own an asset, it's a lot easier and better to hold it. We know it better than anything else, especially relative to a new buy. right? There's a lot of execution risk in getting that, and all the work that especially when you operate your own properties, and maybe this is, also when you're third partying, there's just a lot of work in those first few years to get that property from, par to par plus 50% revenue, right? We're trying to get up revenue 30%, 40%. And when we do that, when we achieve that, and we're able to get to the other side of that, well, what a shame to sell it just a couple of years later. So when we go out to investors, we are projecting a 10-year pro forma. That's our base case expectation. Now, that typically means that our IRRs look a little bit lower, maybe on average, than people who are saying 5 years. But everyone who's an investor and experienced operator understands that. They know that, hey, yes, I can make my returns look a lot better by shortening our hold period. But at the end of the day, it's a lot easier to just stay in a deal and compound at a certain rate versus a slightly higher rate, and then have to go out of that deal, go into cash, find the next deal, find the next deal, find the next deal. Yeah. So 10-year hold, but that doesn't necessarily mean that we're looking to sell in 10 years. We might recap the deal at that point, bring in new investors, let other investors who want to exit. We're mostly working with family offices and high net worth individuals, and they're mostly looking for that long-term cash flow as well. So, we're pretty aligned with that.
Yeah. It's interesting. Statistically, it is the 10-year mark when most investors start selling. And for me, my average hold time was 12 years. Mm-hmm. Over all those 40 years, the average hold time was about 12 years, some less, some more. And it really wasn't like I didn't, at the outset, I didn't say that's what I'm going to do. It's just, you depreciate it so much, it goes up in value. Maybe you're looking at in a couple of capital expenditures in the next 3 to 5 years, like, I'm going to let the next guy take care of that, the roof and the furnace and all that, and redeploy the assets somewhere else.
Yeah.
So now you mentioned workforce housing. What you're really looking for then, or kind of describe what you mean by that. And you mentioned a family. Look, mm-hmm. I love families because they stay a long time. They generally keep up with the place better, and they'll do more painting mm-hmm. and things like that, and cutting the grass.
Yeah.
But tell us about when you're looking to deploy the assets in the marketplace. Do you have a model or a formula that you follow for that too? Like the selection process and screening and all that,
Yeah. So we have a minimum income, median income, value, and 60,000 or higher. And then we want to look at our existing rents and our target rents relative to that, so we can make sure we have affordability. But also we look at what the house values are in the area. So we really want to see is, typically, although 60 is our minimum, most of our deals we're doing at around $75,000 to $110,000 income areas. And then where our rents are typically in the $1.20 to $1.30 range on a pro forma basis. So what that means is a $1,200 to $1,400 rent, which is very affordable in that area. And we're typically appealing to that, 60 to 70% of the average income up to 100% of the average income in that area. Yeah. And then what we really like is when we see house values in that area being 4 times the income. So in that same area, we might see a $400,000 house is going to cost 2 or 3 times what it costs for us to have a similar, not totally similar, but a housing option, right? So again, we're trying to find those folks that are making $60,000, $70,000, $80,000. They want the great schools for their kids. They want a nice size unit that's comfortable, that's safe, that's well appointed. We always do hopefully a really good job. We like to take the worst, sort of the bottom 10% rent, bring it up to say the top third, but again, then give it the top 10% quality so far as hard countertops and just the way the hard product looks. So that's really what we're focused on. And if we see that big gap, then we have a defensible position. We're not so much worried about people when rates fall, shifting over to homes, because they really can't. They can't afford that. So they're renters by necessity is another term that people tend to use. But it's a very specific avatar that we're looking for.
Yeah. Well, what's really nice is there's a lot of people in that category. I mean, just look at home prices today. It wasn't that long ago somebody pulling in 60 grand could easily buy an average. Yeah, that's not the case anymore. Mm-hmm. And yet they generally don't have money problems. The only problem they have is they feel like they need a nice house. It's funny because psychologically, you and I both know it's a want. I mean, we need shelter for sure, but having a nice home, a nice neighborhood, that's a want. But they've got kids, they've got a spouse. They want to be in the good school districts. They want to be in your shopping. They want to have activities for the kids. All those stuff, all those factors weigh in. And even if you have children or have had them, what happens. I mean, it's just like a constant outflow. My gosh, your braces and all the equipment for sports. I mean, just Lord forbid you get a kid that plays hockey, because that's a major investment.
Yeah,
Um,
I have 4 children, so I definitely know the. I
oh
definitely
yeah,
know, yeah, and they all have a lot of needs. They're all under 10, so I'm still
oh
kind of
yeah,
in the thick of it for sure. Yeah.
yeah. And I want to go down a rabbit's hole, but the big shockers, like if you have, like I was Evel Knievel when I was a kid. I was a high adventurer, jumping bikes, and I was always in the emergency room. My poor mom. And nowadays, an emergency room visit. I mean, my daughter had one, the last one, and she's grown now, but I think it was 2011,
Mhm.
and it ended up being like an $11,000 bill. I'm like, and that was with insurance. I'm like, are you
Crazy.
kidding me? What kind
Yeah.
of test did you run, man?
Right.
So, but it just goes to show you, having a product like you have is very necessary.
Yeah.
And Warren Buffett said it in 2011. He famously said, if I could buy 100,000 single family homes, I would do it. And he didn't do that. He bought
Right.
uh,
Home parks.
Prudential, and that became, Berkshire Hathaway Home Services. Now I'm not going to go down that road, but in any case, he said, we're going to be your renter nation.
Mhm.
And I'm seeing the statistics. So just to give people an idea here, all right, every state's different. When I started traveling around the US and Canada teaching, it was right around late 2014, 2015. In 2015, in the state of California, the percentage of renters was 36%. And over the years, it went up 42, 46, and it's going up. It's way over 50% now. And now all of the programs, the incentives for people who are builders and investors are all geared toward providing rentals. None for building owner occupied homes. It's
Mhm.
just a crying shame. But you know what? We can't. Nobody can help everybody, but everybody can help somebody. And what
Mhm.
you're doing is you're providing a value service to them. Maybe they buy a house when interest rates drop, or maybe there's a special grant program in their state where they can get a grant for a down payment. There's always options. I mean, that's one of the things my team's good at, is we call it a certified affordable housing provider. It's a designation. And we help people who want to buy a home and otherwise have, decent credit, decent income. They're priced out of the market, either the value of the home or the lending. We can solve that. And generally, where we work with guys like you, we work with investors who want to do like a long-term play with them contractually. They
Mhm.
build some equity, they have skin in the game. You profit, they finally get a home. It's just an amazing opportunity. So there are things that the private sector are doing right now.
Mhm.
I'm not knocking the government. It's just, the fact is, look at the government. They're fighting each other. That's what they're
Mhm.
doing. They're not really putting out a lot of legislation that benefit us. They haven't done that for a long time. So we need to take the bull by horns and do it ourselves, and that's what we're doing. I know we're going to run out of time here real quick. This happens
Okay.
all the time with a good podcast interview. Guest, and you're providing so many golden nuggets. This is amazing. Um,
Yeah.
when you look at the marketplace, well, let me ask you this. Um, Geographically, so you're in Boulder, but you're investing in different parts of the country. Are you using any particular service or statistics to tell you, hey, this is an emerging market, or this place has recently become stabilized, and they've now got 4 major industries there? And what's your sort of checklist there for where you invest?
Sure. Yeah. So we have every single deal that we look at, we probably have 100 and something different little filters to make sure that we're in tolerance, and that, to
Mhm.
the percentage of units that we don't allow us. We need to have at least 70% of our units being 2s and 3 bedrooms, right?
Mhm.
Or we have the income, or we have the house value, or we have to have a certain amount of revenue growth in the first 3 years in order to make the deals work. So there's just a bunch of different factors. So far as market, we're looking at schools, we're looking at population, we're looking at migration. So we're looking at some of the U-Haul data. We're use RealPage as one of our primary data data providers. We also use Atom and Parcel Labs. Those are two different providers that Parcel is really great at showing us what the institutional single-family home providers are doing. They keep a good eye on that. Atom gives us great information on what's going on the single-family side. Now, on the multifamily side, we're mostly going to get our data from a CoStar, from a Real Page, or Yardi. So kind of have all the different options there, depending on whether what markets we're looking at. And so, generally speaking, what that leads us to is we continue to like generally the Southeast. So we're looking in the Carolinas, in Georgia, Northern Florida, from Space Coast down to Orlando over to the Panhandle. And then Alabama, Birmingham, Huntsville, selectively, as some of their supply issues are, there's some headwinds in some areas, obviously, and not every, don't just, I don't want to just say buy indiscriminately in South Carolina or North Carolina, but these are the markets that we keep an active look at, and we offer on everything that comes in that price range so that we can be on bid sheets, so we can be active in those areas, as long as they hit our, sub-market micro level criteria around those other demographic information. And then I really love the Midwest. But as I had said, we're vertically integrated. We can only operate, I'd love to, if I could, I'd be agnostic to location, but unfortunately real estate, or fortunately or unfortunately, exists in the real world. And so we really need to be thinking about local scale, since we're running our own property management company. So we're very much focused right now on continuing to build our book of business in Georgia, Northern Florida, and Alabama.
There you go. Yep. The Alabama is the new Tennessee,
Yes. Yeah, there you go.
Quite frankly, there's not many left. I mean, what do you got left? You got like Arkansas and South Carolina, and I'm sure the people have already started doing. Well, I know they are.
Yeah.
But I'm not knocking the other states. I'm just saying, as far as golden opportunity goes,
I think there's a lot of opportunity in the Midwest.
Let me ask you this:
for folks that are willing.
Oh yeah. We still like Ohio, Indiana.
Yep.
Indiana,
especially as people move out of Illinois, there's a lot of growth in Indiana. People moving away from the high tax burden, high government.
High tax, high crime. I'll see you later.
I will say that the Chicagoland area itself, although yes, there are, and I've operated apartments in the south side of Chicago, and definitely a lot of crime, so to speak, but I've never been in any of those areas and felt unsafe necessarily. And it's a great city. I just think that, there's a lot of options out there. So you just have to.
I have always liked Chicago myself. As far as big cities go, I like New York for certain reasons, but Chicago is just so easy to navigate. Great restaurants. It's more spacious. It's more modern. There's really beautiful water. People are helpful, and you got Frank Lloyd Wright. Lived there for a while. You could go to West Chicago and visit some of the homes he lived in and help design. It really is a great
different
place.
Different energy, right? Versus the coastal megacities like the LA and the New York. It's just that the feeling, the energy there is very like go 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 go. It's a little bit less like that in the Chicago area.
I agree. Hey, let me ask you this: who's your avatar as far as fundraising funds goes? The money. Let me get the water. Who should be looking for you, or who are you looking for as far as that goes?
Yeah, I would say at least half of the capital that we've raised, over the last 10 years has been from larger family offices with special situations. And so really kind of creating bespoke opportunities for those situations where we can pair, hey, I've got a transaction, I got to do a 1031 or a reverse 1031, or I've got to do an EAT, something, kind of off the beaten path that maybe wouldn't work for, a different group. And so I think we've been able to solve a lot of problems that way. And then the rest of it has come through, high net worth individuals, entrepreneurs, professionals that are looking for the tax advantages, the cash flow, that sort of a thing. But it's a combination of those folks. We have not really spent a lot of time or effort in the institutional space, given our deal size and our our track record is only 10 years now. We're starting to get to the point where that'll be possible now that we're getting into our second decade. Just continuing to build the retail base as well as continuing to get referrals from one family office to the next. So that third group is that referrals. So referrals are great. That's where we see a lot of our growth.
Okay. Now, what's the best way for people to locate you? Can they have a conversation with you? Maybe go over a couple of examples of some case studies you have, that kind of thing, or where's the best place to start there?
Yeah, thanks for asking. If you just go to investwithcarbon.com, and that'll bring you right to our website. You can sign up to get our newsletter. We run weekly newsletters on just things that are going on in the market. We run a podcast on a weekly and basis on market news, what we see so far as deal flow, and we highlight different markets and different things that we're doing in our portfolio. So I'd recommend people take a look at that, subscribe to our newsletter, and then you'll start getting our information.
Okay, so everybody listening, if you're driving, don't write this down while you're driving. We'll put this on the show notes for you, so you can go to the website. You can go to right now. You can go to globalinvestoragent.com, and you can, under resources, get to the podcast page. It'll have this on there. So I'm gonna call it out to you slowly. It's Invest with Carbon, CARBON.com. And if you're looking to invest, you just don't have the time to be running around looking at properties and fixing things and doing remodeling and all that yourself. You just want to, get a return on your money in a really good, safe, secure way. I suggest you work with Michael. I've met a lot of people, Michael, who do this. We've done several hundred interviews over the years. I do know some family offices, and I can tell every listener here, for Michael to be working with family offices is a major green check mark in the right green box. There's a high element of safety and security there and trust. I'm not an attorney, I'm not an accountant. I'm just telling you, if you know anything about family offices, they don't work with just anybody. So they're working with Michael, and so should you. So go to investwithcarbon.com. Michael, thanks again for being on the show, man. Any final word of wisdom, like from your granddad, something that I know he was the king of the hill in his day, but
Sure.
Something that stuck with you over the years, and
Well, now that you said it, my grandfather on my mother's side would always say, "Don't do anything you wouldn't want to see on the front page of the Wall Street Journal." So I always thought that was a pretty good moniker to think about, and and I think outside of that, I would say that I assume most of your listeners are either aspiring investors or investors or passive investors or active, and so if you're looking to be an active investor, you just start small. You're going to have to put some money to risk, and so figure out what that is for you. 3-5% of your net worth, maybe 10%. Don't go crazy. Expect that money is part of your tuition of learning this business, and you're going to be in this business hopefully for 30, 40, 50 years. And that first deal, is that domino. Once you get that first deal done, it's either the thing that you say, "Hey, I'm never going to do real estate again," because you had a horrible experience, or you do it and you're like, "Hey, I got the bug." So go to Gary, let him teach you how to do it, and you'll have a good experience. And then that first deal will just be that first domino in a long series of dominoes that, gets you to financial freedom or whatever you're looking for.
That's awesome. Thank you, Michael.
Yeah.
And thank you, listeners and viewers. And if you wouldn't mind, leave a good review for this one, guys. Michael just dropped all kinds of golden nuggets right in front of you. My gosh. And you got it totally for free. If you can leave a review, take 30 seconds to do that. We both appreciate it. That's your review is our fuel. That's what keeps us going. So thanks to everybody. Take care of yourselves. God bless you and all your loved ones. And we will see you on the next Massive Passive Cashflow Podcast.
Thanks for listening to this episode of Massive Passive Cashflow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.